I'm Glenn Freeman for Morningstar, and I'm joined today by Simon Doyle, Head of Fixed Income and Multi-Asset with Schroders. Now Simon, just firstly, on the multi-asset side of things, how popular is this approach with retail investors? And have you had to adapt this to be more popular with that segment?
Well, certainly, I think multi-asset generally has adapted quite significantly over the last, probably 8 to 10 years. And certainly, we started really evolving our approach, probably around 2007, 2008, moving away from the traditional balance fund structure towards an objective-based portfolio approach. And that we did that really to try and solve some of the problems that were inherent in sort of traditional balance structures, and really align with the sorts of issues that our investors were facing. That was how to deliver decent positive rates of return without the volatility that you typically get with a balanced portfolio and without the drawdowns that sort of come with that. And so that's been the main sort of evolution of our multi-asset approach.
What are some of the main trends that we're seeing there? Is it that drive to reduce costs and fees for investors, or are there other things happening as well?
Well, I think pressure on costs and fees are, they're industry-wide, they're sector-wide, they're not really unique to multi-asset. I think within multi-asset, I'd say probably the single most evident thing that's happening is really innovation. In the last 5 or 6 years, there's been a plethora of new strategies launched into the domestic market, available to domestic investors, both institutional and retail. Objective-based portfolios, so like ours, where a lot of the value is really through managing asset allocation and making sure you're in the sort of the right parts of the market at the right time. We're seeing the development of strategies that are very much dependent on cross-market or relative value trades. And that's sitting alongside risk parity type approaches, or even sort of combinations of the three. And so, I think competition and innovation, I think, is really driving multi-asset managers to continue to deliver interesting strategies that sort of really try and sort of solve the core problem that investors have in different ways.
From a retail perspective, who is your audience, and has there been much popularity among SMSF trustees?
Well, from a multi-asset perspective, I think our core constituency, if you like, in terms of sort of the natural investors in these types of strategies, is relatively broad, but probably focused on investors who are coming up towards retirement and really don't want to see sort of big drawdowns in capital. Investors who are maybe post-retirement and are looking at sort of generating decent income without sort of significant volatility. Investors who are sort of indifferent to what they own, so they're not worried about whether it's equities, bonds, property, or what have you. What they're worried about is the profile of the returns of their investment, the income that delivers, or investors that actually otherwise have relatively narrow portfolios that don't have a lot of, are unable to get a lot of diversification. And I think it's that latter category that sort of captures a lot of the self-managed supermarket, where they may have relatively concentrated portfolios, but are looking to find a way to diversify their exposure. And multi-asset strategies, like our real return fund, actually do have some appeal for them to be able to do that.
And just lastly, some market commentators have been quite dismissive of active investment approaches, with index managers having done quite well in recent times. How do you respond to that?
Well, if I put my multi-asset portfolio manager hat on, I actually think that sort of the active versus passive debate is a bit of a distraction. It focuses very much at the sector level, sort of equities or bonds. It suffers from, I think, what I'd call a recency bias. It's very much dependent on sort of the performance of active and passive managers in the most recent couple of years. And I think it ignores risk, particularly the sort of risk that's been brought to bear on markets based on the behaviours of central banks. So as a multi-asset portfolio manager who's looking to deliver absolute outcomes for my clients, there isn't a passive portfolio that I can own. So I need to take active risk all the time to be able to do that, and I do that via asset allocation, and we all all portfolio constructors need to be active in the way they think about asset allocation, simply because there isn't that neutral portfolio.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.